let's look at dividend valuation model. Remember where we are coming from. We said there are 4 groups of method for valuation. There is asset-based, there is dividend valuation model, there is income or earnings model, and there is cash flow model. Now we've dealt with asset model, and for asset model there are 3 forms. There is book value, there is net realizable value, and the third one is the replacement cost value. So we've dealt with 3 of them. Now we're going to second group, which is dividend valuation model. And very important, because you need to know this for its suitability. This is very similar to what you've learned in cost of capital, because this makes use of dividend information. So use the dividend information to calculate the value of the business. Yeah, so which means this is only suitable when dividend will be paid forever. That is for foreseeable future, in perpetuity. So talking of perpetuity here. If you remember, when we spoke about perpetual value under investment appraisal, forever perpetuity. And that's the same assumption that this model makes. So therefore, the price or the value of a share, equity, is equals to the present value of all future dividends. Simple. So it's the present value of all future dividends. That is the price of that share. That is the way it's been done. And if you remember the cost of equity formula, we said cost of equity is current dividend into 1 plus G divided by P naught plus G. It's this same formula that is being used to determine the price of a share. All you need to do is to rearrange the formula such that you will bring P naught out. And if you try to do that, you discover that KE minus G now equals to D naught into 1 plus G divided by P naught. And with this, you can bring P naught to this place and bring this one down to this place. In that case, P naught becomes D naught plus, into brackets, 1 plus G divided by KE minus G. And ladies and gentlemen, that is the formula for the dividend valuation model. And what is P naught? You already know that P naught is the price of the share that we are valuing, right? And D naught represent the current year dividend. And we have G, you know that as well, is your dividend growth rate, just like you have in your cost of capital class. This is the average constant rate you expect dividend to grow into the foreseeable future. And KE is the cost of equity, or cost of capital. And that's it. And in terms of advantages and disadvantages, let's look at that quickly. So I'm going to put advantages here and disadvantages here. The first good thing about this approach is that this approach considers time value of money, which is very good. Considers time value of money. Yeah. Likewise, it's very useful for valuation of minority stake, and I will tell you why. So very useful for valuation of minority. And you remember who is a minority. Minority are those people that have less than 50% ownership. They don't have control. Yeah, and because they don't have control, they are not able to take decisions that can influence performance of a company. They are not able to take decisions that can influence expansion. Yeah, those decisions that can make the share price to go up. So capital gains cannot be their focus, but rather the only sure thing for them is just the dividend. So it only makes sense in terms of shareholders' expectation to use the dividends to do the evaluation. So that is why this approach is very suitable when you are trying to get the value of a minority interest. Very good. But it has its disadvantage, as you can see. G is always difficult to calculate. Because how do you calculate the constant dividend growth rate in the for the foreseeable future? It's very difficult. So this is very difficult to calculate for sure. Yeah, and in reality, G is not constant. Though this formula, assumes that it's constant, but it's not possible. Because no matter how perfect that company is, they cannot grow their dividend constantly. They can keep growing it, but at the constant rate, it's very unlikely because a lot of things will happen. COVID-19 will happen. Recession will happen. That you can't even make profit, let alone of being able to declare the same amount of dividend or even increase at the same rate. So it's never constant in reality. So that's a disadvantage as well. Yeah. And if a company is loss making, you can't use this method. So not applicable for a loss-making company because they don't have dividend information. So a loss-making company or a company that will not be able to pay dividends, you can't use that. But let's look at an example to even see how we can apply this this learning. Yeah. So look at this question. Company D has the following information. We have the share capital in issue is 2 million. Current dividend per share is 4 cents. Dividend 2 years ago, 3.3 cents. The equity beta, 0.6. Equity risk premium, 10%. Risk-free rate at 5%. Then we're asked to calculate the market value of company D. Very important question here. Now, to calculate the market value of company, we already have dividend information. So we know that we'll be using the dividend valuation model. That price is equals to current share dividend into 1 plus G divided by cost of capital minus G. Now, the question is, do we know D naught, the current share dividend? Yes, we do. That is $0.04 because that's 4 cents. Do we know the growth rate? No. Cost of equity? We don't know. So we don't know these two for us to be able to do the valuation. So we need to calculate our G and calculate our cost of equity. Yeah, from the knowledge of your cost of equity, cost of capital, let's calculate cost of equity. Here we have to use CAPM because they already gave us beta information. So using CAPM formula, this is what we have to do. So cost of equity equals to RF is the risk-free rate of 5%. Beta was given to be 0.6. Return on market is not given, but we're given the equity risk premium, which is return on market minus risk-free rate. So, and that is 10%. So which means our cost of equity is 5% plus 6%, and that equals to 11%. So we know our cost of equity now to be 11%. So the only thing we are left with is the growth rate. And for growth rate, remember the way I told you to do it is to always remember your future value method, which is equals to present value into bracket 1 plus r raised to power n. Yeah, future value is the most recent dividend information here, which is the current dividend that is being expected to be 4 cents. So that's 4 cents will be equals to the oldest dividend, which is what we have here is 3.3 2 years ago. R is what we want to calculate, which will be our G, and the time between those two dividends 2 years ago. So that will be raised to power 2. And therefore, 1 plus R raised to power 2 equals to 4 divided by 3.3. And in that case, we have 1 plus R will equals to this raised to power 2. We'll bring it to the other side. It becomes square roots. And 4 divided by 3.3 is 1.2121. And therefore, 1 plus R equals to 1.1009. And our R equals to 0.1009. That is 1.1009 minus 1. Then R equals to 10.09%. And that is our G. So 10.09 is our G. So now we plug all of that into this formula. And we're going to have price equals to dividend of 4 cents plus $0.04. Because I want to get price in dollars. So $0.04. I know my G now. My G is 10%, 10.09%. Divided by KE, I know it is 11%, minus G, 10.09%. If I press all of that on the calculator, my price is equals to $4.4 per share. So that is the price of 1 share. But the question is a market value of the year. It is a market value of the, but it's good to give it, since the question already gave us the share capital in issue of 2 million, then we can get the total market value. Because no 2 million shares is what they have. So total market value will be price per share of 4.4 times the total number of shares that we have, 2 million shares. And that will give us $8.8 million. And that's value of company D. And that is it. As easy as it is. Now, having done that, you are now very comfortable with dividend valuation model. You can see it's almost just like a revision of what you already knew when we dealt with cost of capital. Still moving on, and I'm moving on to the third method, which is the third approach, and that is the income or earnings approach. Income, or what you call the earnings approach. Yeah. And like we always start, suitability. When do you use this method? Suitability. Yeah, this particular method is now very useful when you are valuing the majority stakeholder. Remember, when you are doing dividend model, you use it for minority stakeholder, but this one is very suitable for valuation of majority. That is people that have more than 50%, people that have control. Majority shareholding. Yeah. Because they have control to expand the business, they have control to generate more earnings. Those are the things that will definitely increase the price of the company, increase the earnings of the company. And in that case, it's good for them to value their investment. using the expectation of the future earnings from the business, because in their hands, they control it, right? And here we'll look at two forms. Yeah. The first one is the PE ratio approach. And then earnings is there, and the other one will be the earnings yield approach. Earnings yield approach. Those are the two forms that we'll be looking at. Yeah. And let me quickly tell you, for PE approach, I know I've dealt with PE when I spoke about ratios, so it's the same thing that we're talking about here. It's not different. So, but just a reminder, remember that PE ratio is just your price per share divided by earnings per share, or the market value or market capitalization divided by the total earnings, which is your profit after tax. Either of these will give PE ratio. And why is it so important to mention? It's very critical because of the common mistake that students make. And I always say, please, I'm going to repeat again. Anytime you want to do a valuation of a business using the PE approach, you must use the PE. So always use the PE of a benchmark. Always use a benchmark PE. You cannot use the PE of a company to value itself. You cannot. You have to use another PE. So use a benchmark PE. Most times the benchmark PE, your first choice, especially in mergers and acquisition, is to use the buyer's PE. The person that wants to acquire the business. If that is not available, then you can be using a proxy, similar company PE. Yeah. Okay. So it's very important to note that. Yeah. And in terms of suitability, you can already see it. You need the price. So very useful for listed companies. Yeah, though you can still adapt it for the unlisted companies, but you need to get the P ratio of a proxy that is listed, right? So that listed company is very, very critical. Okay, so now how do you use this to get the price of a company? We have already said that PE ratio is equals to price per share, which is what you want to calculate. So let's say price per share of company X divided by earnings per share of company X. The question is, which P ratio are you going to use? I've told you, and I'm saying it again, please, you cannot use the P ratio of company X to value company X. So which means the price per share of company X that we are looking for will be equals to PE ratio of, because I'm going to multiply by this, of a benchmark company multiplied by the earnings per share of company X. So that is how you use it. Use the P ratio of another company multiplied by the earnings per share of the company you want to value. And that is how you use it. And I'm going to work an example. The other form is the earnings yield, because I'm going to take them together because it's the same approach. In fact, it's the same thing. Yeah, earnings yield. What is earnings yield? Earnings yield, like I always tell you, anytime you hear yield, is price. So that means it's earnings over price. So earnings yield is earnings per share divided by the price per share. So invariably, what we are saying is that it's the same thing as opposite of price earnings ratio. So it's inverse of price earnings ratio. It's just the inverse, because what you have done is earnings per share over price per share is equals to earnings yield. Yeah. But remember that price per share over earnings per share is equals to PE ratio. So it's the same thing. It's just opposite, inverse, right? So, and I'm going to work an example to deal with that. Let's look at an example. Yes, this example, like this. Yeah, look at this example. You have company D that is planning to acquire company G. And we have the information for both companies: profit after tax, share price, and earnings per share for company D and company G. We have all of that. But what company do we want to value? We want to value company G. So which means if we're going to use price earning ratios to value company G, we need to use the price earning ratio of D, because D is the acquirer, D is the buyer. So we can't use the P ratio of G to value G. We need to use the price earning ratio of D to do that valuation. So what's the price of D? Price of D is $3 and earnings per share of D is $0.2. That's 20 cents. And in that case, we'll have 3 divided by 0.2. So what would that be? 3 divided by 2. We have 15. So the P ratio of D is 15. So which means we can now use the P ratio to do our valuation. P ratio is price per share divided by earnings per share. So the price that we want to calculate is equals to 15 multiplied by earnings per share of G. So earnings per share of G. So price of G is equals to 15, which is P ratio of D. Then that multiplied by the earnings per share, that is 1.2. So that's total earnings. Actually, we don't have earnings per share, so we can still use the total earnings, and that's 1.2. When you use total earnings, what we have is the total value of the company, so which is good. So it still will give us 18 million. So that's $18 million. So this is the total value because we use the total earnings. So that is the total value of the company, total market value of the equity of the company. Yeah, as you can see, if you had the number of shares, we would have been able to calculate the price per share. But for now, all we have to do is 80 million. Yeah. And if you want to use earnings yield approach as well, is like I said, it's the same thing. Yeah, if you want to use earnings yield, that means you need to be using the earnings yield of D, the buyer. Yeah, which means that is earnings per share divided by price per share. Yeah. So if we want to do that, it means that our earnings per share of D is 0.2 and the price per share is 3, and that will give us 0.2 divided by 3. We have 0.0667. Yeah, so and we know that earnings yield of D is equals to earnings per share of G divided by price of G. So we can get the price of G by dividing earnings per share of G over earnings yield of D, which is the proxy, the benchmark that we are using. And that equals to earnings per share of G is given as 1.2, that is total earnings that we have, then divided by earnings yield of 0.0667, and that will give us, let's see, 1.2 divided by 0.066667, that gives us 17.999 million. Similar, that is approximately 18, which is the same thing as what we have here. So whether I use price earning ratios or earning yield is the same approach, but the most important thing you should take note is the fact that you must always use the price earning ratio or earnings yield of a benchmark, which usually will be the buyer.